Greetings, everybody. Welcome to Liberty Call. Today is Monday, March 27th, 2023. Much better day in the markets. See a lot of green on the screen. I'm not sure why everyone's so happy. The NASDAQ took a bit of a dump today. It was down about 0.5%. Looking across the rest of the globe, other than the overnights in Asia, lots of green across my screen here. So hope everyone had a good weekend. The Cougars lost on Friday, which was a major disappointment, but, these things happen. So at least they're playing good the last few years. I can't complain too much. I mean, it'd be nice for them to finally win a championship. I mean, it was 40 years ago at this time when they choked against NC State, and then the next year they lost to Georgetown. I was there. It was very upsetting. I was giving the middle finger to every Georgetown fan I could I guess it was 10. I was a nice kid. Anyways, if it's your first time watching, please give me some big old thumbs up, like, share, subscribes, follows, all that good crap. And let's go ahead and jump into the numbers for today. Dow Jones was up 0.6%, closed at 32,432. It was up 194 points. SP 500 up 0.16, closed at 39.77. NASDAQ, like I said, was down 0.47, closed at 11,768. VIX was down 5.24% today. It's currently holding at 20.6. Canada was up 0.63. Brazil up 0.85. Mexico up 0.15. Over in Europe, Germany up 1.14. UK up 0.9. Same with France. Netherlands up 0.56, Spain up 1.29, Italy up 1.21, Switzerland up 1.43, Portugal up 0.85%. Both Russian exchanges in the green today. MOEX up 2.06, RTSI up 2.47. And the overnights in Asia, starting out with the Nikkei in Japan, it was up 0.33. Australia was up 0.1. In China, the Shanghai was down 0.44. The Shenzhen Component up 0.12. China 50 down 0.48. DJ Shanghai down 0.35. Hang Seng down 1.75%. Taiwan weighted was down 0.53. All right. That's everything as far as the markets. Let's go ahead and jump on over to the weekly economic update. Let's see what Genius is in here. Let's go ahead and dive in. The week on Wall Street, modest gains in major market indices masked sharp volatility amid the concerns. Amid the uncertainty arising from mixed messages emanating from public officials and revived banking fears. The Dow Jones Industrial Average gained 1.18% last week, while the SP 500 added 1.39. NASDAQ rose 1.66, and internationals were up 3.29%. Turbulent week for stocks. The stock market was unable to find sustained direction as investors weighed comments from Fed Chair Jerome Powell and Treasury Secretary Janet Yellen, the dumbest human on the planet. I'm going to say that every time I say her name. Stocks initially rose as banking fears eased following a deal to acquire a troubled Swiss bank. Optimism was further fueled by Yellen, who said the government could intervene to protect depositors if more bank issues materialize. I don't remember the legislature voting on this. I guess they just do whatever they want at this point. Enthusiasm faded, however, when Yellen subsequently testified that the Treasury was not working on any blanket insurance for bank deposits, and by the Fed's warning that banking turmoil could shrink lending access. The volatile week ended up with sharp intraday price swings, shrugging off revived European banking concerns. Rate hike cycle ending? Will it? Last week, the FOMC, the Federal Open Market Committee, meeting was particularly noteworthy. Fed officials were placed in the difficult position of balancing the banking system's opposing risks of still high inflation and stressors. The committee had considered leaving rates unchanged given the banking stressors, but unanimously voted to raise rates by 0.25%, citing elevated inflation, resilient economic activity, and a strong labor market. The official announcement hinted that the Fed might soon be done with raising interest rates, while also stating that it was too early to ascertain the degree to which the economy could slow from the current banking strains. All right, economic data coming out this week. Tuesday, we have consumer confidence. Thursday, jobless claims and GDP. Friday, personal income and outlays and consumer sentiment. Just two companies reporting earnings this week. Tuesday, tomorrow, we have Micron Technology and Walgreens. All right, well, that's the scoop for the weekly update. Let's jump on over to today's market recap, see what they had to say. Dow rides relief in banks to close higher, but tech wobbles. All right, let's get my notes here. All right, on Monday, the Dow closed higher as First Citizens Bank shares announced its purchase of the remaining assets, deposits, and loans of the failed Silicon Valley Bank for $72 billion, providing relief to investors. The deal represents a discount of $16.5 billion and is expected to propel First Citizens Bank shares into the top 20 U.S. banks. The news boosted the bank's shares by over 53%, and other regional banks also surged, including First Republic Bank up 12%, Comerica up almost 6%, and Bank of America up 5%. The market also received a boost from reports that U.S. officials are exploring the expansion of the Federal Reserve's emergency lending facility to regional banks. How nice! How nice of our government to do that. They're so generous with other people's money. It's amazing. However, gains were limited by a stutter in big tech as Treasury yields surged following Federal Reserve Bank of St. Louis President James Bullard's comments about higher rates. This caused pricing for the May meeting to increase by 5 to 6 basis points, with half a quarter point rate hike now being priced in. Hang on, I got to blow my nose. Hey. I'm back. Did you miss me? I'm sure you did. Alrighty, where was I? This caused pricing for the May meeting. Yeah, we already covered that. Apple, Meta Platforms, Alphabet, and Microsoft were in the red, while Pinterest rose over 2% after UBS upgraded the social media stock to buy, citing evidence of improved advertising efficiency. In other news, Novartis shares jumped 8% after the drug maker announced its late-stage trial showed its breast cancer drug significantly reduced the risk of reoccurrence in women. In the cryptocurrency world, the Commodity Futures and Trading Commission filed a lawsuit against Binance and its co-founder Changpeng Zhao for allegedly selling unregistered crypto securities in the U.S. And the U.S. Securities and Exchange Commission threatened to sue Coinbase Global for allegedly listing unregistered securities. All right. Well, that's everything for the market recap. It's good that the government's spending time, fishing around about cryptos and things like that. If people lose their ass on that, that's their own problem. Do your own homework, make sure that you're investing appropriately. But anyways, yeah, they got to stick their nose into everything. All right. Next up, next article is titled "The Fed Waffles." Comes from our friend Brian Westbury at First Trust. And let's see what he has to say. Last week, the Federal Reserve raised short-term interest rates by a quarter point, targeting a range for short-term rates between 4 3/4% and 5%. However, the article argues that the most important issue in monetary policy is the money supply, which has surged by 40% in the first 2 years of COVID, the fastest since the 1940s, and has since dropped by the most since the Great Depression. The article notes that it's surprising that the Fed does not prioritize paying attention to the amount of money its policy measures create, which is the most obvious explanation for what happened with inflation in the last few years. Also, the article questions the Fed's focus on short-term interest rates and where it might be heading in the next few years, with the new, quote, dot plot, end quote, from the Fed suggesting one more quarter point rate hike this year, although 7 of 18 policymakers thought rates would peak even higher. The article notes that between now and the next meeting in early May, the Fed will not see much key new information on the path of the economy. The article also argues that the current financial problems are very different from those of 2008 and 2009, with the primary issue being interest rate risk or duration risk on high-quality bonds. The Fed has set up a new facility for banks that lets them offload those securities to the Fed for a small fee, papering over balance sheet problems for banks able to make a small hit to earnings. The oddest part of the Fed's decision on Wednesday was the issuing of economic forecasts that included a recession starting later this year, but not talking about it. The Fed is now forecasting 0.4% growth for 2023, even as the Atlanta Fed's GDP Now model predicts a 3.2% real GDP growth in Q1. Even if you plug in 2% for Q1, the only way to get 2.4 for 2023 with 2% in Q1 is if the level of real GDP is lower in the fourth quarter than it is in the first quarter. Factor in the Fed's forecast that unemployment averages 4.5% in Q4 versus 3.6% in February, and it looks like a recession is on the forecast. All right. Well, again, not much that I disagree with what Mr. Westbury says. He's usually pretty spot on with his stuff. So, the article's linked. If you want to go ahead and read through all of it in its entirety, you can do so. All right. Last up is article from Mises Wire, Why Fractional Reserve Banking is Behind the Bank Failures, written by Jonathan Newman, and it was published today. The recent crisis of Silicon Valley Bank, which suffered a run on deposits in the wake of interest rate hikes, has reignited the debate about fractional reserve banking. Austrian economists have been critical of the central banking and government manipulation of the money supply and interest rates, but some have different opinions on fractional reserve banking. The fundamental problem with fractional reserve banking rises when banks combine warehouse banking, simply storing depositors' cash with payment for service, and loan banking, using deposits to extend loans. This creates the possibility of depositors requesting more money than the bank has in reserves, especially as not all deposits have matching cash reserves. This happened to SVB, which used depositors' funds to purchase treasury securities and mortgage-backed securities and to extend loans to high-tech firms. Although no bank keeps 100% reserves, the repeated bank runs and associated financial crisis caused by fractional reserve banking have led to the creation of central banking, government deposit insurance, and a multitude of bank regulations. While some believe that fractional reserve banking is not a problem per se, it's the moral hazard and money creation by the government that causes all the problems. Others argue that the debates over the sustainability and ethics of fractional reserve banking suffer from poorly defined terms, and that the economic consequences of fractional reserve banking are less important than the debates about its sustainability and ethics. Regardless, if depositors view their checking account balance as one-to-one money substitutes, then prices and spending patterns will reflect the depositor's own net worth calculations and expectations of disposable income. If a bank expands credit on top of that via fractional reserve banking, then the supply of credit and interest rates no longer reflect the depositor's underlying real preferences, and this can cause economic instability. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope you have a great night, and I'll talk to you next time. Adios.